If you're trying to understand where the next global confrontation is really heading, stop watching warships drifting through the Taiwan Strait. Military hardware is performance theater. Aircraft carriers can sail for drills, flex for headlines, and quietly return to port. They are meant to be seen. They are meant to distract. Real intent doesn't move that fast. If you want to know whether a superpower is preparing for a point of no return, you don't track missiles, you track money. More specifically, you track sovereign debt. More specifically, sovereign debt. Debt is slow. Debt is heavy. And when a nation starts dumping another nation's debt aggressively, that is not portfolio management. That is preparation. This week, buried inside a dull U.S. Treasury report, we got a warning most people missed. China's official holdings of U.S. Treasury bonds have fallen to about $688 billion, the lowest level since 2009. That number sounds big. But historically, it's a collapse. In 2013, China held over $1.3 trillion in U.S. debt. They helped fund American deficits while exporting cheap goods. It was a closed loop that powered globalization. That loop is dead. China has sold nearly half of its holdings, over $600 billion gone. And the timing matters. Most of these sales happened during the worst bond market in decades. Selling then means locking in losses. No rational investor does that unless the asset itself has become dangerous. China is not short on cash. So why sell? Because after 2022, Beijing learned a brutal lesson. When Russia invaded Ukraine, the West froze $300 billion of Russian reserves overnight. Money Moscow thought was untouchable vanished with a few keystrokes. China watched closely, and they realized something terrifying. If conflict erupts over Taiwan, U.S. Treasury bonds are not assets. They are hostages. The moment sanctions hit, those bonds could be frozen or wiped out. So China is exiting now, even at a loss, to avoid a total loss later. This isn't panic. It's strategy. But here's the problem for America. For decades, the U.S. could run massive deficits because China was an unlimited buyer. That buyer is gone, and now he's a seller. So who's buying the debt China is dumping? Look at the data. The United Kingdom and Belgium. Britain's holdings of U.S. debt have surged to record levels, nearly matching China. But the U.K. doesn't run trade surpluses. It doesn't have excess dollars. That means leverage. Belgium's surge points to financial plumbing, custodial accounts, and proxies absorbing the shock. This is not a free market. This is allies being forced to step in to stop the bond market from breaking. But this has limits. Unlike China, Europe, and the UK don't produce endless surplus. By absorbing U.S. debt, they're weakening their own economies. China knows this. This is a war of attrition, financial, not military. While the West shuffles paper, China is doing something far more important. It's converting paper money into physical reality. Gold, oil, copper, rare earths, food. China is stockpiling the raw materials needed to survive sanctions, blockades, and war. This is the mindset shift. Peaceful nations chase returns. Prepared nations chase survival. China is willing to lose money today to avoid being strangled tomorrow. That's why this matters to you. U.S. Treasury bonds are no longer risk-free. They are political weapons in a global economic war. If the world's largest manufacturing power is leaving the market, you should ask a serious question. Why are you still in? The stability you see right now is artificial, held together by allies, leverage, and pressure. When that support cracks, the adjustment will be violent. The divorce has already been decided. We're just waiting for the system to